Hello and welcome to our second installment of the Established ESOP Forum. We have designed the forum to support you as you lead your companies through the many phases and stages of implementing and managing your ESOP. The purpose of today's forum is to shed light on the valuation process as it relates to and impacts your ESOP. After the panelists speak today, we will have significant time for questions and answers. The goal of this event is to provide high-quality insight, so your specific questions are welcome. Even if you feel that your question may only apply to your company, rest assured that there is someone else that will benefit from your asking it. And if you wish to remain anonymous, just leave out specifics that may identify you or your company. You can submit your questions through the chat feature, which the moderator and panelists will be able to see. As a reminder, the format of Zoom webinars does not include video or microphone. This means that other attendees and panelists cannot hear or see you. Questions and comments placed in the chat room are encouraged. After the end of the forum today, we will ask you what you thought of the event and how often you think you might want to engage in content like this to benefit your company's ESOP. First, I want to introduce the experts who will serve on this panel today. We designed this panel to provide a 360-degree expert view on any ESOP question or topic. So each panelist represents a unique and important perspective from the key aspects of law, valuation, trusteeship, and plan administration. First is Corley Thomas, a managing director with HDH Advisors. Corley's experience focuses on providing a wide variety of valuation and transaction support consulting services for the purposes of financial reporting, tax planning, contemplated M&A, and general business planning. He has significant experience in performing equity and enterprise valuations, debt valuations, and complex deal structuring consulting. Kristy Britsch is an attorney in the corporate group at Levenfeld Pearlstein with a focus on ESOPs and general ERISA and executive compensation matters. She has more than a decade of experience advising closely held businesses on incorporating ESOPs into their business succession planning. Joel Davis is a vice president of ESOP consulting at Principal. He has more than 26 years of experience in the retirement planning industry and has extensive experience working with companies that have employer securities in their plans. His areas of technical expertise include consulting on ESOP transactions and plan design for companies going through an ESOP formation, as well as working with existing ESOP companies on issues such as repurchase liability analysis, ongoing funding strategies, and plan design optimization. Finally, we have Neil Brosen. Although Neil may have a scheduling conflict and may not be able to join us, we're keeping our fingers crossed. Neil is president of Ventura Trust, serving as a trustee for many ESOP plans. Neil co-founded Ventura in 2016 after working for two institutional trustees since 2005. He oversees the relationship management team of Ventura with responsibility for more than 140 ongoing clients. In his career, he has been responsible for more than 400 ESOP transactions, including new formations, second and third stage purchases, third-party sales, terminations and redemptions, refinancing, and releveraging. Today's topic is the art and science of valuation. Valuation truly is a combination of art and science in order to arrive at an enterprise value for your company. A firm will use multiple methods to arrive at a value, and there are many factors at play within those methods. Who is involved in the process, and how can a company impact its valuation results? We are going to find out. With that, I want to start with a few basic questions to set the table for our conversation today. Then we will dive into more detailed issues and finish with questions from our audience. Corley, let's start at the basics. What is a valuation and what is its purpose?
Sure. So evaluation in the exercise, we're going to look at what is the value of the business with the ultimate goal of arriving at what is the value of a single share in the company. That's the primary purpose of it. They're generally used for for trustee administrative purposes to establish the individual share values so that the trust can report to the participants what their account balances are worth. A couple of other reasons why valuations are used. Some of your ESOPs that you guys are involved in may have warrants, and at times those warrants need to get valued if they're going to be exercised, or if the ESOP is electing to call those warrants. There could be a need for evaluation in those circumstances. Other needs could be if there are additional shares being acquired. Some ESOPs may not own 100% of the companies that they participate with. You could own 30% or 25% or any percent for that matter. And over time, as additional shares may get purchased, evaluation is needed in those instances as well. And I guess the last one that I would point out, but I think anybody who would be here on this call, this would be behind them, but it would be for the initial transaction as well. So when an ESOP is being formed, a valuation is needed in order to establish what is the fair market value of the business that's being acquired on behalf of the participants. So those are some examples of why valuations are needed. But the vast majority of the time, it is that annual valuation for ESOP share administration purposes.
And Corley, what makes someone qualified to do a valuation, and who engages that valuation firm?
Sure. So there's a couple of credentials out there that valuation professionals obtain. Probably the largest one is an ASA, that's an accredited senior appraiser, and it's issued by the Appraisal Foundation. There's a credential also called an ABV, which is issued predominantly for CPAs, and that's for an accredited business valuation professional. But truthfully, there are professionals out there in our community that provide valuation services that don't carry either of those credentials, and that's okay. There are a lot of guidelines and reporting requirements that go with valuations, and so as long as a professional has experience doing valuations and is meeting all of those reporting requirements and guidelines, they would have the ability to do a valuation as well. In terms of who engages the valuation professional, it's generally always going to be the trustee. The valuation professionals within the ESOP space are working on behalf of the trustee to help the trustee determine the share price. Although the valuation professionals are the ones that ultimately issue an opinion as to what the shares are worth, it's the trustee that's establishing that share value. And so as a result, the valuation professionals work on behalf of those trustees. You guys may have run into issues when you may reach out to your valuation professional asking for a copy of a report or whatnot, and get redirected to the trustee. That's the very reason why that's happening, is ultimately the valuation team is working for the trustee directly.
Great, thank you, Corley. This was a question I wanted to ask Neil, but I see that he hasn't been able to join us. So Kristy, maybe I'm going to ask you and get your perspective. What role does a trustee play in the valuation?
So that's a good question. It's one that we get asked often a lot. Essentially, the trustee, and Corley hit on this, and it's probably the most important, is the trustee is the one who A, hires the valuation firm, even though the company's paying the bill, but also B, they're setting the share price. So as Corley mentioned, they're doing, Corley, him and his team are doing all the background work. They're meeting with the company. They're asking for financial information, sitting down with management, talking about projections. Did you hit past projections? Are you going to hit future projections? The trustee is involved in those meetings and conversations and is getting that sort of feedback, if you will, and documentation. And when Corley does all of his valuation magic, gives that information to Neil, and Neil is the trustee, or as any ESOP trustee, they then agree to that price or set that price, which then gets communicated to the company, and also gets communicated to Joel and principal for account statement preparation. But the main role of the trustee is setting your share price.
So that kind of leads me to another question. Corley, do you get a lot of pushback from trustees or from the company at all when you do your valuation? What happens in those situations?
Sure. Yeah. So once the valuation is completed from the valuation team, you're going to circulate a draft over to the trustee, and you ask Jeff about pushback. The trustee certainly engages. They want to review all the major inputs and assumptions that went into it. They want to have a discussion around those, and there are instances where they may disagree with something, or they want a deeper analysis on a certain topic. I think that's an important part of the trustee's involvement in the overall valuation. They need to make sure that they're aligned with what the valuation professional is opining to. And so that is common. In terms of company pushback, technically the valuation is being done on behalf of the trustee. And so it's designed to be done without the company's influence, without management team being able to influence the conclusion. Now that doesn't mean that discussions have to happen between the valuation team and the company around making sure that everybody's got an accurate view of the outlook, right, or an accurate view of ad packs or whatever the case may be. So there are instances where company feedback is important, but ultimately it's directly with the trustee in terms of where feedback is coming from.
Good. And Kristy, just as a follow-up question, this back and forth between the trustee and the valuation firm, is that being documented in some way, or what happens with that?
Yeah, that's a great question. It is. So I guess I'll take this in two parts. So the first part is at the ESOP transaction level. Whenever the initial ESOP transaction is occurring, so the sellers are selling stock to make the company become an ESOP, legal counsel is heavily involved in that process in documenting for the trustee's file. So not only do you have the trustee and their committee or their internal team taking notes and documenting all of the discussions that are happening between trustee and valuation firm, you also have the legal counsel doing that. So that's happening at the sort of pre-transaction. After you're an ongoing ESOP, some trustees bring legal counsel in, some trustees have internal legal counsel. So you will still have the trustee team taking those notes. Whether or not it's outside counsel getting engaged is another question and probably trustee specific. But yes, when Corley and his team are meeting with Neil and his team, somebody at Neil's shop is taking heavy notes because they need to document the file. And this becomes important in future years as you were an ESOP for several years and you're going along your way. If something changes in the valuation report, so if Corley's using one method and weighting that it's a specific percent, maybe in 5 years it's weighted differently or not used, those things become very important to look at the notes in the file and say, why did we do this 3 years ago? Why are we not doing it now? Why are we changing that? So yes, there will be a complete record on the trustee side from transaction all the way through the life of the ESOP.
Okay, good. Thank you. I want to bounce over to Joel for a minute, if I could. Joel, what does the TPA do with the information from the valuation after you receive it? How does it impact the participants? What happens?
Yeah, good question. And if we get this a lot because oftentimes companies think that once the share price is communicated to the TPA, that you click a button and statements are ready the next morning. And there are a number of things that we're waiting on ultimately for that final share price to be determined. And chief among those really is that the preliminary allocations get run, which provides the data for the TPA to be able to do the compliance testing. So that share price is going to impact the 415 testing, which is the participant level test that limits how much people can get through the 401k and the ESOP in any given year. It's going to impact, in many cases, the maximum deductible contribution limit for companies at 25% of eligible pay. For companies that, especially companies that have stock appreciation rights, it will affect your S corporation anti-abuse testing, the 409p testing. So there are a number of different compliance tests that get impacted directly by that share price and where it comes in. Also, it is depending upon the allocation formula, the share price may affect things one way or the other. Kristy highlighted on the big one though. The share price obviously is, participants have a certain number of shares and the value of their accounts is going to be impacted one way or the other by what's happening with the company's share price. So it certainly needed to produce those final statements to update the website or mobile app or other ways that the value is being communicated to the participants as well.
And is that same valuation being used then for terminated participants in order to calculate what they'll be paid out?
Yeah, so anybody that remains invested in company stock, whether they're terminated or active employees, it will impact the value of their accounts. Absolutely. Yeah.
Good. Moving on then a little bit. I guess this was a question I was going to ask Neil, but again, I'm going to throw it out to the group and kind of get feedback from all of you. Should company projections be conservative, aggressive, or somewhere in between? What's the right approach for a company when they're doing their projections and that? Should they be going for pie in the sky? Should they be, careful and conservative and make sure that they can meet those numbers? What's the right balance?
Sure. Yeah, I can take that, and then Kristy and Joel, feel free to add in on what you guys have seen. But certainly, out of the three options, conservative, aggressive, or reasonable, we'll go with reasonable. That's the direction you want to go. When you think about the projection that's being put together, it really should be what I would call the mid-case scenario. So there should be an equal probability that the business outperforms the forecast and an equal probability that it may underperform the forecast, right? So we want that midpoint forecast. An aggressive projection really isn't going to do anybody any favors. I think there's a couple of things that can lead to. It could lead to overvaluing the shares in one year, and then the following year, when the valuation firm realizes that there was a big miss in the forecast, you can then have a contraction, and that leads to share price declines, and that unnecessary share price volatility, I don't think does anybody any favors from a participant perspective. And then on the conservative side, I think setting out a conservative forecast is going to mute some of that share price volatility as you're dialing expectations back. So that's our point of view in terms of how projections can impact the outcome, but ultimately you want a reasonable projection.
And great, thank you, Corley. Kristy, is there from a legal perspective then, are there concerns about being overly aggressive or overly conservative? I mean, I'm thinking if you're overly conservative, maybe your share price isn't as high, and then somebody that terminates is maybe unhappy about their share price, that sort of thing.
Yeah, I mean, that's correct. And Corley kind of hit the things that I would have mentioned on the head, just from if you want to mitigate legal risk here. When you do your projections, those also go into SAR price and hitting SAR targets. If you have performance SARs, for example, those projections and what you're forecasting the company to do sort of dictates whether SAR is vest or even get granted. And you don't want to have an overinflated price or over aggressive projections or forecasts, because those SAR targets will never get hit. And those are really great recruiting tools. Those are great retention tools. And so you could be left with management feeling a little deflated because we gave these projections 5 years out. I get SARs, performance SARs based on hitting these projections, and we're not hitting them. And so I have nothing. So that's a concern, maybe more of a communication for management, or people might, not trust management. You don't want to have any reason to give your employees a feel deflated sense of what does this ESOP mean for me? And what are these SARs? These are just meaningless benefits and empty promises. And that's not what they are. And you don't want to give that impression to management or to the employees. In terms of, being too conservative or too aggressive in sort of what you're providing to the valuation firm and to the trustee, again, reasonable, middle of the road is the way to go. And Corley hit on this. You don't want to have an issue where participants are getting account statements and they're seeing the share price is really high one year, it's really low the next year, and it's having these dramatic and really drastic fluctuations. That's going to, again, give this level to your employees of distrust and what's going on here. So you want to avoid that because, the reasonable is the way to go, just to kind of keep everything even flow. Things seem realistic to management, employees, and you're not setting yourself up for not only unhappy employees or in management team, but also people going sort of chatting. I mean, people talk. So people getting together, talking about what's going on. Why did you get paid out at this price? I got this very low price. And then, finding a plaintiff's attorney. So reasonable would be my suggestion.
Good, thank you. And Joel, on the same subject then, from a repurchase obligation discussion, that does being overly conservative or overly aggressive have an impact on that, and what should companies be aware of?
Yeah, it certainly would, and I guess, Mike, I was thinking that in most cases, and Corley, maybe you can opine on this, but my assumption is that as those projections go from the company to the valuation firm, that if the valuation firm is looking at those and vetting the numbers and thinking that they are out of line with what it sees as the company's, growth opportunities, and maybe historically what the company has done, that a lot of those issues get ironed out well before they get to the participant level. But in a case where, that could be a case generally where even if you thought those numbers were appropriate and the company underperforms or outperforms, it absolutely will have an impact on repurchase obligation. And, we see this each time that there is a recession. You've got this period where terminated participants are generally getting paid out at the share price as of the most recent year end. And, in the 6 to 9 months since then, if the company specific situations have taken the stock price one way or the other, or the economy has, where, the payout is either much higher than the share price might be if the valuation were to happen, on the exact date the distributions are happening, or vice versa. I think some of that is just inherent in ESOPs in general, and there was a lot of conversation about that when COVID hit. And some industries were hit much harder than others, and what exactly do you do in those situations where, as of 12/31/2019, yep, those projections, they look perfectly reasonable, and the share price was perfectly reasonable, and by the time you get to paying distributions out, you've got the question of whether or not there needs to be some intervening factor to prevent, generally the distributions from happening at a value that is much higher than could have been anticipated.
Okay, good. And so, Joel, kind of, I guess, continuing with that whole thought process and that, and talking about repurchase obligation and ultimately what participants are going to receive as a benefit somewhere down the road. Why is participant education so important, especially as it relates to how they can impact company value, and how might that differ from industry and job function and things like that? Yeah,
and this is, first of all, I'll say that everybody that's on this panel works a lot in the ESOP transaction space and works intensely with the business owners and the CEO and the CFO And by the time the deals are done, you probably understand the ESOP better than you want to. But the employees who are going to be the participants in these plans, they generally know nothing as this plan is created, even oftentimes as they get their first statements. And it's a position that I'm a little envious of, working for a publicly held company, that if I have a really great year, I'm moving the needle this much, right? For a lot of ESOP companies, you have the opportunity, if you spend the time and, in some cases the money, to make sure that you relate the opportunity in receiving these shares each year to how they can actually move the needle. And so I would say the companies that have been most successful from a cultural perspective are those that are making, helping employees understand things like, for each additional dollar of profit that we have, what might that relate to in share price? Or we had a client years ago that would, on an ongoing basis, solicit input from employees on what the company could do more efficient, and did a really nice job of relaying, whether you increase revenue or reduce expenses or adding that additional amount to the bottom line, what is happening. And they ended up with very material changes. In one case, retrofitting a warehouse that got them an additional few years of warehouse space for their current operations, rather than having to build a new warehouse in a high interest rate environment. And in most companies, you can find ways to make those things relatable to what people are doing on a day-to-day basis for their job. Some of them are universal, regardless of what the company does. Some of them are very specific, whether it's a manufacturing company or an engineering firm, or another type of company. It's the number one thing that I would say is don't put together a really solid transaction, and then when it comes to the communication piece, leave it short, where the employees don't necessarily know what it is, why it is, and what they can do to influence the growth of the company.
Yeah. And I think, Joel, part of what you're referring to is earnings multiples and things like that, while people like myself and other financial professionals might understand what those are, there are a lot of folks working for the company that don't have that sort of financial background. And I think providing that education and at least helping them understand it on a basic level provides that light bulb sometimes for people to understand why it's so important to make that extra effort.
Absolutely.
Kristy, did you have some other thoughts?
I agree with everything that Joel said. I think, a lot of us that are on the transaction side of these deals, when we get to work with the clients after the deal closes, and Joel is, with the account statements, kind of at the forefront of that. But yeah, making sure that your employees understand, no matter what their job is in the company, if you can be efficient, everybody's job is important and helps company growth, and really kind of get that culture and sort of education that, I don't care what your role is at this business, it's very important and vital into the betterment for the whole here. So that is very important. I know Joel's group has a communications team that can help work with people specifically for those kinds of issues if they come up. So there's a lot of resources out there for communications. And to Joel's point, the worst thing I think we all don't want to see, the worst thing to happen would be you have this great transaction and everybody's very excited. And then, the company 3 years down the road, employees don't get it. They don't care. They don't see their value. They don't see the general value. And so communication is key. And for understanding your role does affect share price in some aspect.
Good.
Jeff, one thing that I often relate this to is, our youngest daughter is 23 and living on her own for the first time. When she lived at home and she was a teenager, we had to put motion sensing lights in her bathroom because she didn't really care about the fact that lights and electronics got left on all day long, right? She's got her own place and paying her own bills, and all of a sudden she realizes that stuff matters. She's got ownership in paying those bills now, and I think that that's an analogy that can be used in an employee company.
Yeah, that's a great analogy, Joel. You're spot on. Exactly. Changing gears a little bit, Corley, I want to get into maybe a little bit of more of the nitty gritty here about valuation and that. One question that came up is, you know, a debt to equity ratio might be actually higher than what an appraiser would use when they're doing the weighted average cost of capital. Why is that, and why does it matter?
Sure. Yeah. So definitely more on the technical side of questions here. So anybody on this call has probably looked at their valuation and sees that there is that weighted average cost of capital input, or it may be abbreviated as WACC. And as part of that, there's a selection of how much capital invested in the business is equity and how much is debt. And in the ESOP space, certainly initially, most of the capital is actually debt, right? Most of the transactions that we see, the ESOP borrows money from either the sellers or a bank or a combination of the both. And so we've seen questions like that before where people say, wait a minute, you know, our debt relative to our equity is much higher than what you guys are selecting in the WACC. The reason, though, is when a valuation professional is valuing the ESOP, the business, you've got to look at the lens of what could this business be sold for in the open marketplace. And in the open marketplace, how much debt and how much equity would be normal for this company? Initially, when an ESOP is formed, that high level of debt is not normal for a company to operate with that level of debt in the long run. Over time, that debt is going to come down as payments are made, and you're going to start to see that debt to equity ratio become more normal. But initially, it may not be there. And so that's the reason why your valuation team may be using a different debt to equity ratio than what the business actually currently has.
Makes sense. Thank you. So sort of along the same lines in terms of more technical aspects, if a company is going to start funding its repurchase obligation, and I've seen companies do this both ways or a combination, but some companies keep it on the balance sheet. They accumulate the cash that they need to meet those future obligations. Other companies actually make contributions into the trust and create a sinking fund there. How does that decision impact valuation of the company?
Yeah, so so for anybody that's listening, if you attended our last panel, we sort of talked about this as more in the context of using this to fund repurchase obligations, but it does have an impact on value. Corley can probably get into more how much of a difference does it actually make, but as you grow in your ESOP and people are becoming vested and retiring, starting to leave, but more importantly, after they're becoming fully vested, the company needs to have cash to pay that, and you can put money into the ESOP. And when you do that, it is a tax deduction. So there are IRS code limits that you need to sort of be mindful of to do that, but you can put cash in the ESOP for the purpose of addressing diversifications if you're 10 years into your ESOP, or to fund distributions as people leave. So that's one way to do it. Now, keep in mind, when the money goes in there, the company can't use it. So if you need to pay a large bill or you need to come up with cash for some emergency situation, you can't go into the ESOP and take that. So it's in there, it's staying in there, and it's only going to be for distributions or diversifications. Think of it in contrast, if you're keeping that same money in the corporate, at the corporate level, the corporation has cash. So if there's an emergency situation, even though you may have earmarked that for repurchase obligations, the company can access it if it needed to for some sort of emergency situation. What does that mean? Well, when the cash is at the corporate level, that's an asset. So when Corley's looking at his work and he says, how much cash do you have? That would get reported to him. Take that into the reverse. If that same cash is in the ESOP, well, that's not corporate cash. And so that would impact value because it's less cash that the company has at its disposal to use as it sees fit. Whether or not that's a drastic change, I'll let Corley sort of chime in on that one.
Yeah, Corley,
Yeah.
that, you know, those are good points that Kristy has brought up, and maybe you could talk a little bit more about the scope of what happens when companies make those decisions, and you know, specifically how that affects the valuation.
Sure. Yeah. You know, it's a challenge that we see mature ESOPs dealing with. They recognize it's important to preserve cash and hold cash to fund these repurchase obligations. But as they continue to execute on that, the repurchase obligation grows, right? Because the more and more cash you start to stack and accumulate on the balance sheet, the greater the share price, and then therefore the greater the repurchase obligation. So, you know, we've seen some instances where that can be a challenge that has to be navigated. And I think Kristy touched on the biggest decision that management teams have to make is, okay, if we move this cash out, if we just picked $1 million, if we move $1 million out of the business into the trust, all things being equal, value will decline by $1 million. So we're mitigating that growth in the repurchase obligation through the increasing of the share price by moving that $1 million out. However, as soon as we do that, we now no longer have access to that $1 million. So if there is an opportunity that the business has to maybe expand or acquire some additional assets that will lead to growth, or conversely, if there's a downturn and the business needs that cash to fund operations temporarily through that downturn, it no longer has access to that. There really aren't any circumstances where that cash can come back into the company. And so, you know, that's the dynamic that makes for a pretty challenging business decision. And those are the thought processes that I think teams work through.
Right.
Jeff, I'd love to weigh in on that one too. And I wasn't part of the repurchase liability session, so I can throw my strong thoughts out there without having to be consistent. I would say one of the beauties of being a 100% ESOP owned company is that, you know, in most cases, you're taking the tax aspect of making contributions to the ESOP out of the mix. You know, that if you are a partial ESOP, you're still getting you're getting the deduction if you're a 100% ESOP owned company too, but it matters less because in most cases you're not paying federal income taxes. Most 100% ESOP owned companies tend to, you know, I call it cash starve the ESOP, but really it's just, you know, rather because of the things that Corley and Kristy have talked about, especially the flexibility of keeping that money on the balance sheet, it allows you, yep, it's still there if you need it for a repurchase obligation, but you can use it to take advantage of strategic opportunities and weather tough times or whatever you might do with that. Making a contribution to the trust that, yes, you can use it for a repurchase obligation in the future. You can use it to segregate and take terminated employees out of company stock. And those are, you know, especially the conversion or segregation, I think it's a pretty valid reason to make those contributions. But you're also, you know, making those cash contributions with the understanding that some of those participants are going to terminate or retire and take that cash with them, and it will not get used ultimately for repurchase obligation, or may not get used. So we tend to see most companies, unless they're making contributions for a very specific reason, if they are 100% ESOP owned, of looking at keeping that money on the balance sheet and retaining that flexibility, even though, like Corley said, it does have an impact on value.
Thank you. And I just saw this question pop up from our audience, and it's kind of a related question. So Corley, I'm going to throw this at you. Does the repurchase obligation liability that's typically not recorded on the balance sheet, how does that play into the actual valuation of the company?
Yeah, so I think different valuation teams are going to view this differently, but something that everybody is likely seeing in their valuation is a discount for lack of marketability. that the concept behind that discount for lack of marketability is the shares are not cash. They can't be immediately converted into cash like shares of a public company could be. And so there is some timing risk of the conversion of the value of those shares into cash. And that's within the valuation community, what we call marketability. Generally speaking, I would venture to guess that most of the valuations that everybody on this presentation is seeing contemplates around a 5% discount for lack of marketability. But if there are issues where the company does not have the ability to fund its repurchase obligation, the valuation team is likely going to revisit that discount further. And that could come in two forms. One, either calculating specifically what the repurchase obligation is and the shortfall that is there, or two, making a decision to increase that discount for lack of marketability. Those are probably the two most common that we've seen in terms of how it's addressed. Now, in instances where there is ample cash available to support the repurchase obligation, and the ability to convert the value of those shares into cash is not a concern, then you may not see the valuation professional explicitly addressing that building liability because the business is supporting its ability to pay those obligations out of cash flows.
Great, thank you. Another question that I want to ask, and this one might be a little controversial or have some back and forth on it, but and Kristy, I'll start with you on this. But if a company has an upturn or downturn during the year, can the valuation be done on a day other than the last day of the plan year? Who decides that? What happens there?
So the short answer is yes, it can be done. And I think the first time in my career that I've seen this actually happen is during COVID. So the plan document, your ESOP plan document or the ESOP trust agreement should dictate when is fair market value determined. And there are, I like to say, 3 times that would be determined. Number one is the last day of the plan year. So each ESOP is operated on a 12-month plan year. The last day of that year is the accounting period, and that's when share price gets determined. So that would be number one. Number two is whenever the stock is exchanging hands. I know Corley hit on this earlier in the introduction part of our panel, but if the ESOP is buying the stock from the sellers at the initial outset, that is a fair market value determination date. The same thing if you do a second or third stage ESOP transaction. So you want to become a minority or majority over time. Those are all trigger dates for fair market value. The same would occur if the company is getting purchased. So what is the fair market value on the date the company gets purchased? So that would be number 1 and 2 is fair market value date. The third that we see in our trust agreements say this is any other date that the board determines. Normally that is tied to some sort of financial criteria. The board decides it because the board may be different than the plan administrator. Some companies have a plan administrator serve in a capacity as a plan fiduciary. Others do it as more of a communications. They're more of an ESOP communication committee. So we like to make sure that the board of the company is the one determining if financial situation within a business has changed so much so that they don't think the 12/31 price, and I'm just using that as an example for a last day of a plan year, but that 12/31 price that we're paying a bunch of people out is overinflated. COVID happened and our company is losing customers. We don't know if they're going to come back. What do we do? So we did see clients in that time period I would say June was our typical date when they realized that this was not going away and people were scared and didn't know what the future was going to hold. So we did have some clients revalue stock mid-year because they felt that the 12/31 value was just going to be too high and that was going to impact long-term repurchase obligations as well. So It can be done. Usually the board decides it. I wouldn't want your ESOP committee to decide it. They don't really have a outlook on company and client base and things that the board would. Obviously, the valuation firm and the trustee would be involved in those discussions because Corley and his team would need to do the valuation, and you would need the trustee to sort of approve this for, you know, whatever reasons the company feels strongly about would justify a different valuation date.
Right. Corley, any other thoughts on that subject?
No, I think Kristy really covered a lot of the bases in terms of when that comes into play. You know, it's certainly a case by case situation, but yeah, that was well covered.
Yep.
Okay, good. Well, I think we're just about at that point. These have been great questions, great discussion. I think we're at the point where it might be time to take a couple of questions. So let's jump into that and see what we come up with here. What I'm looking at is about being an S Corp ESOP. The person noticed in their DCF, the discounted cash flow approach that their evaluation firm used, the taxes are being deducted from their cash flows. And the question is, why is that happening, and why does that need to be included? So Corley, any thought on that?
Yeah, so I think the nature of the question is if the ESOP if the company is 100% ESOP owned and it's an S Corp, you know, that entity technically doesn't pay tax. But to your point, inside of the income-based approach or the DCF or discounted cash flow approach, you're going to see your valuation professional still calculating what the tax is on cash flow. And that's going to be a reduction to the cash flow, which reduces value, all things being equal. The reason why that's being done is it's important to try to understand what is the value of this company if it was sold in the open marketplace. So although the company is ESOP owned now and benefits from this unique tax structure, if the company were sold in the open market, buyers would presumably have to start paying taxes again, and they're going to contemplate the impact of those taxes when determining the value of the business. And so within the ESOP valuation, it's always important that the value is derived from a fair market value point of view. In other words, what can this company be sold for in the open marketplace? And so that's the reason why the ESOP specific tax attributes are not going to be factored into the valuation itself.
Great, thank you. That's very helpful. Appreciate it. Joel, I want to direct this next question that I see here to you. I think we've sort of touched on it already, but what are best practices for educating ESOP participants and helping them understand valuation? What does principal do, and you know, what should management teams be thinking about when they go to provide this sort of education?
Yeah, good question. And as Kristy had mentioned earlier, we do have a team that does ESOP education on specific topics like this one, and some of our competitors do as well. So I think for us, one of the biggest things, and this isn't necessarily content related specifics about the valuation itself, but taking what can be pretty complicated topics and try to make them relatable to employees. And so, you know, as far as best practices, what we've seen with valuation is comparing the company's financials like to a household budget, and that as you're coming down, you know, what money do you have left over to be able to invest or to operate your household, and how that ultimately translates into your net worth. Making it, we talked a little bit already about making it relatable to their job. That it's one thing to say, you know what, if we increase how much money we're making, and we find a way to hold expenses steady or reduce them, that we're going to have more money left over, and here's how the multiple, you know, simplistically gets applied and that kind of thing. It's altogether different if you relate it directly to the work that people are doing on a day in and day out basis. You know, for manufacturing companies, how do you reduce scrap? How do you, are there ways to make the machines that we're using operate more efficiently, or that we can use fewer machines, those types of things, but really trying to make it relatable specifically to what the people are doing on a day in and day out basis. And I think about this all the time, like with a summary plan description, which is supposed to be a layman's version of this 100-page plan document, but really what it becomes is a 30-page document that is still largely legalese, doesn't go into a whole lot of specifics, and we're basically checking boxes to make sure we've got all the requirements met for a summary plan description. That it's better than having people read the plan document. It's not as good as having them read a 2-pager on, here's how you get in and what you get, and how you get your benefit long term, and so speaking to people really the way that people talk, and which I think is a pretty unique skill set. Take all the complicated topics that we deal with and make those relatable for the rank and file in general.
Great.
Jeff, just to kind of tag along to what Joel said, and I'm sure everybody on the panel can agree and has probably heard this in some form or fashion, but a lot of companies will say, we want the employees to understand the value when they see these statements, the share price, why is it going up 1 year? Why is it staying the same? Why did it go down? And understanding what their part is in that. And some clients will ask, should we share all of our financial information with them? Everybody probably has a different opinion of that. My thought would be, if you open up the corporate financials to everybody, some of them are probably not even going to understand what they're looking at. Some of the best ways I've seen that sort of handled is some of our companies, they do annual shareholder meetings. They're actually employee meetings, but they call them an annual shareholder meeting. And sometimes they use that as the opportunity to actually hand deliver participant account statements. Or they'll do it to say, hey, principal's going to be mailing your account statements. We just want to give you a heads up. This is what share price is going to look like, so that they're not opening up these statements in shock. Sometimes they get in shock because the price jumped so high. Other times they're in shock because the price is lower than they thought. So for them to understand that, these meetings, I find for our clients that do this, are very, very beneficial. The companies are not actually sharing very specific company information about financials. They're not putting up, balance sheet, but they're offering up, slides or just general presentations of, this is what the company generally did last year compared to this year. This is why this price is going to be the same or different, up or down. So offering up more general financial information, like maybe the client lost a big customer, whatever the reason might be, but to kind of share that kind of information more at a general level and not getting into specifics. Here's our balance sheet, opening up all of your financial records. I don't think that's going to be beneficial. People are not going to understand that. But keeping it at a high level, general, I think that can go a long way in sort of tying that to these account statements that Joel's team is going to be sending. I think it goes over a lot smoother than maybe not doing that, because you're not going to get bombarded with phone calls. Why did my price go down? Why is it so high? What does this mean? Can I take money out now that my share price is this high? Just answering all of those questions out of the gate, I think, can go a long way.
Well, Kristy, you must have been reading my mind, because I was just going to raise the question of transparency, and we've gotten several questions from people about that, and I think you're spot on. I normally don't interject too much during these discussions, but I will say that, from my position when I ran an ESOP company, that transparency was probably one of the most important things we did in terms of the participants that were involved. I completely agree with you. Taking the financial statements and just handing them out, I think it would bewilder a lot of people and probably raise more questions than provide answers. In addition, you're putting your company at risk by having those statements floating around out there and having them potentially fall in the wrong hands. So I'm generally not in favor of doing that, but what you just described in terms of having an annual shareholder meeting, having some slides talking about some of the parts and pieces that people can relate to, whether it's talking about your gross margin percentage and understanding how little is actually left to cover all the overhead expenses after, after you've provided the product or service that you provide. And knowing that, or understanding, what does it cost to employ all of us, right? How much, what are the wage costs, not specifically, but in general, in combined terms, how much does it cost to employ all of us, including our benefits and everything else that goes into it, and understanding how big of a number that can be, and how hard we have to, how hard do we have to work, and how much additional gross margin do we need to be able to meet those obligations. So I think that can be really, really beneficial. And I will say, in our own company, we experienced, I think, more participant engagement and excitement once we started doing that than anything else that we did to try and provide education for our participants. So that's great. Thank you very much. There's one or two more questions. We've got a few minutes left. I want to try and jump to these as quickly as we can. Corley, major differences between an ESOP valuation and a normal business valuation. Are there any, or is it the same exact approach?
Yeah, the methodologies really should be the same. You're going to see income-based approaches. You're going to see market-based approaches. The methodologies should be the same. The types of adjustments that are being made to the company's cash flows should be the same. Now, there may be minor differences in the sense of some of the topics we covered, like the repurchase obligation, right? That may not exist with a normal business valuation of a normal non-ESOP company, right? So there are certain instances where the ESOP itself may be dealing with something unique. We've seen preferred stock, the ESOPs own preferred stock. There's, I think earlier in the call we mentioned SARs. There's any number of things that could be subtly unique to the specific ESOP. But at the end of the day, the methodologies under which your evaluation team is arriving at the conclusion should be the same as what would be done in a normal business valuation.
That's good. Last question here, I think, for today. Somebody's asking, they see something in their valuation called a specific risk premium, Corley, and maybe can you talk about what is that, and how can they manage or reduce that risk premium?
Sure. So I'll try to answer this quickly. That risk premium is designed to say, what is the incremental risk attributable to this company that may not exist in other businesses in the marketplace? Examples of that could be, maybe the company has a customer concentration where maybe 30% or 40% of the revenue is coming from one customer. Another example could be forecast risk. Maybe the forecast is viewed to be aggressive. We talked about that earlier. And there's some execution risk or some uncertainty as to whether or not the business is going to be able to achieve its projection. So that's what that premium is doing. Those are some examples of what that premium is trying to capture. In terms of how to reduce it, I think what I would encourage is having a conversation with the valuation team to say, what are these specific risk factors that you guys are identifying? And once you have transparency on what those risk factors are, you're going to be armed with the information on how to try to reduce it. So in my example, if they've identified a customer concentration, you now know if we want to reduce this premium, we need to focus on trying to broaden our customer bench, right? And developing new relationships to diversify our customer base. It could be a key person risk, right? Maybe there's one key person inside the organization that's critically important. Well, now we know we need to try to strengthen our management team and pass some of these responsibilities on. If it's forecast risk, that lends itself to that discussion we had earlier of, is it better to be reasonable or conservative in our forecast, right? And that would be a mechanism of reducing that risk premium as well.
Great, good answer. Thank you. Kristy, did you have a thought on that?
I don't. I think Corley, and maybe this whole panel, I just want to say this, valuation is a mystery and everybody wonders what goes into it and how does this magic number appear. Some of these basic things, like in the specific risk premium that Corley just mentioned and other discount percentage rates or discounts and percentages that are getting applied, understanding that for the companies that are listening out there, just understanding how does all of this work together. You don't need to get into the nitty gritty and understand all of the details that go behind it, but understanding this is why these discounts are being applied. This is why the value is becoming what it is. Just understanding at a high level these kinds of things, I think, is very important, and it kind of reduces people getting angry at the valuation here to say my stock price should be higher, or I disagree with things. Just understanding why certain things are the way that they are, I think, and just a general education is the way to go.
Any final thoughts, Kristy?
No, that's my final thought. Just
Very
understanding
good.
general valuation, like, you know,
Good.
specific risk premium, that sort of a thing. But no, there's the valuation process doesn't need to be a mystery, and you have a lot of good advisors in our ESOP community that are happy to answer questions or, you know, sort of direct you to who would be the best
Right.
one to answer it. So don't be shy to reach out to your advisors.
Thank you. Joel, any final thoughts?
Nope, I would agree with Kristy and Corley.
Very good. Corley, you want to wrap it up and then we'll have our sign off.
Sure. Yeah. The last thing I would say is what Kristy was echoing is I encourage, if you have questions, reach out to the valuation team that you guys are already working with. They'll have the answers, and I think you'll find they're happy to engage with you on the questions that you have.
Right. Thank you. I want to say thank you to all of our panelists today. I think it was a great conversation. I really appreciate your input. This session obviously is being recorded. It will be on Lazear's website sometime in the near future, and there should be contact links for all of the panelists attached to that as well. So if any of our listeners today want to reach out and ask something specific from any one of us, feel free to do so. We're happy to help in any way that we can. Again, thank you to everybody. I appreciate your participation, and have a great day today.
Thank you.
Thank you all.